how seller concession work when the buyer uses a USDA loan.
But first, let's hit it. Hi, this is Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our YouTube channel and podcast, please subscribe and get notified.
Honestly, contact all the time at 252-327-3357. So don't be shy. We love talking to you. Now let's talk about seller concessions when it's actually a USDA loan. Now, USDA loan is a great product in our area because it is a government-backed mortgage available for rural areas. We have a whole video on how to qualify for USDA, so I won't get into too much detail. But what's amazing about the USDA product really quickly is that zero down payment, which means you can be walking away with nothing for down payment. However,
you need to be very also careful that you will still have the closing costs.
Absolutely.
And these expenses and closing costs include some items like appraisal fee, the title insurance, the credit report, lender's fee, and other expenses that comes with it.
Now, typically in our area, I can't speak for the nation, but in our area, it's about 3 to 5% of the home price. But every situation is different, 100%. And sometimes those closing costs can actually be financed right into your loan as well. It just depends on your mortgage exactly and what it appraises for and your lender and how they do it. So once in a while, it's even more amazing that your lender can finance some of them. So borrowers might be able to have the home, or that's where we come in as realtors. You can have the borrower might have to ask the home seller to cover the cost for closing.
Yes. Therefore, now we're going to say how we can reduce the closing costs with the seller concession. That's what we wanted to talk about.
Now, especially at the timing of this video, seller concessions are a real thing again. This is not a seller's market, it is a buyer's market currently with the filming of this video. So, and there's a good news that you can actually ask for it and it might be okay to actually accept it. You still need to know what limits are though. The USDA allows the buyer loan related closing costs to contribute up to 6% of the loan amount known as concessions to cover those taxes and insurance and things like that. So depending on your situation, it might be either all upfront financing, it might be that we have gone in and asked for the financing right at the beginning of the loan, and that means you could be walking into a house with almost nothing except that due diligence fee. Does that sound amazing and too good to be true? Probably, but it is a real loan. Yes, and why would the seller really want to pay your closing costs anyway? Well, like I said at the beginning, it's a seller's, it's a buyer's market, right? And then USDA is still a great loan product out there, so you know it's financed, it's backed, and so it's a typical common thing to be asking sellers in this type of market. Now, there are downsides to asking the market, though. Let's talk about it. The downsides of asking the seller to have concessions. What is that? What's the number one? While it seemed like a no-brainer to have a seller pay closing costs for USDA loan, there are some downsides that my wife didn't say. Well, I want you to think like the seller. Which one are you going to pick more? Someone who's asking you to contribute, yes, or someone who's not asking you to contribute? So when you're picking the offers, you're going to try to not pick the one that has the least amount of concessions, so your buyer is getting, the seller is getting the most amount of money for their house. So home prices, home inventory, all contribute to the market conditions that are going to say if the market is hot or cold, and if it's colder, that means they are more likely to accept concessions, which is what we're talking about right now. And it also depends on how hot that house is. So if that house still has 14 offers, let's be honest, with 14 offers, what are you gonna get? You're not going to get those concessions. But let's make an example. If it's been on the market for a couple while, though, we are talking. Let's say you are purchasing a home with the $250,000 sticker price, okay, which is like an average in our area in North Carolina. And then let's say that for the sake of this sharing with you the numbers, we have average of $6,000 closing costs in our area. Therefore, what's going to happen, you might put an offer for the seller that you are going to buy and pay for this house $256,000, no?
And then that additional money, what it goes?
But then we're also going to put in the offer seller concessions,
exactly,
$6,000, which means you can already have it in the contract in writing that you will be getting some sort of concessions. If you're not putting that in the contract, that's not good, to be honest. Like, that's what your realtor is making sure that you're getting. So that money that you've gotten in concessions, so it looks like the seller is getting their asking price plus a little more, but it's not really getting more. They're just you're getting it in closing costs.
Exactly. Then,
but it has to appraise for that.
Also important to note also the difference between the limit of the seller concession for the different type of loans, no?
Right. So we already said USDA allows up to 6%. But just to give you comparison, VA is much stricter with it at 4%. FHA is like the USDA at 6%, and then your conventional conforming loans can be up to 9%, which is amazing.
Yeah. And seller concession for the USDA loan all amount like a very friendly for the buyers among all of their. Why? Why they are?
Because conventional buyers can't really get into that 9% right up there, like for seller costs and to walk into a house almost free. So the USDA approach to closing costs and concessions is a reason a buyer should definitely be thinking about this loan.
Exactly. I hope this video and podcast.
Don't forget to subscribe to our channel.
Subscribe. And see you in next podcast and video.